tell everybody kind of what you focus on beyond the normal kind of tax strategies, the Augusta Rule, accountable plans, retirement planning, those sorts of things.
That monthly rental income is enough to service the debt associated with the loan, plus leave a little bit of cash left over each month. So you are forming a profitable equipment rental business with this. We're not losing money.
Hey guys, welcome back to the Real CFO Project, the show that's dedicated to helping you become the chief faith, family, finance, and fitness officer of your life. And those are the people that you influence. We try to unpack the disciplines, systems, and personal leadership required to build life anchored in purpose, clarity, and alignment across all four of those pillars. And specifically to those individuals that are business owners, feeling the stresses of the day and everything that comes with it. This is a place where we provide guidance in all areas, all four of those pillars. And today I'm excited to bring in as a guest today, one of our partners when it comes to advanced tax strategies, things that you can do kind of outside the box that the normal folks aren't doing to save tax money, especially for small business owners and high net worth individuals. So with that, I want to welcome Dwight Dye.
Thanks, Chad. Thanks for having me. Appreciate it.
Yeah, you bet, bud. So you've been in the game for about 15 years doing taxes, right? But strategy is something that you and I both kind of started pouring into recently, you a little before me, but tell everybody just kind of 30,000 foot view, the last 15, 20 years, your history, and then we'll dive into some more technical stuff.
Well, it all started with my dad. He owned the tax office where I grew up. And I remember early on when he started his business, he was going to flea markets and preparing tax returns while people went shopping. And then eventually people would come to our house. And that grew so much that he needed a building, a place to meet clients. He and my wife, or he and my mom already owned a building that they did some custom art or custom framing and things out of. So he moved the tax office into that building. And when I graduated college, I didn't have a job lined up, and I was moving back home. And he's like, "Hey, I need help at the tax office." And I said, "I don't know anything about taxes," because I would just give him my W-2 from bagging groceries, and he'd fill out my return. So I did that for 2 years out of college, and he taught me how to do taxes. I had to get a real job because my wife and I were wanting money. I say real job, meaning a year-round, health insurance, 401k type deal with my wife or my fiance and I, who's now my wife, getting married. But I've always had that entrepreneurial spirit. Even with my parents having jobs, they've always had a side hustle or, some sort of extra income that they've produced. And I guess about 15 years ago, a national tax firm reached out wanting to know if I'd be interested in opening an office in Nashville. And, I've seen what the tax industry's done for my parents. So I figured it was worth talking to them. So I opened that office. I think tax year 2013 was the first tax season. And from there, I grew to 3 offices. I acquired 2 existing offices and kind of expanded. The problem, though, was I was so involved in the day-to-day, I was trapped at that Nashville office, and I couldn't really oversee the operations. And I think that is one problem with a lot of people in the tax industry is we're too involved in the day-to-day. So it's hard to run the business side of things. So I ended up selling the Nashville office, and the 2 offices that I had acquired, the clients didn't know me really at those locations. So that made it easier for me to step back and, not be in the grind come tax season and be more supportive, for the staff. Yeah. Well, that also gave me a lot more free time. And some high income people started reaching out wanting to save money on taxes about 4 or 5 years ago. And I figured, why not try to drum up, 15, 20 people that I could work directly with? And so over that time period, just constantly trying to learn these new strategies, new ways to really help people make a big impact on their tax savings. So that's where we are today. I'm all the time researching and looking
Yeah.
for new ways to help people.
Yeah, I can attest to that. I think we follow similar paths. I think I started in the same national firm with a few years prior to you, but we've been through that same journey and then taking that transition out of the office and focusing more on your business. And it's interesting, when you're tied to clients, it becomes difficult to separate yourself from the overall or operations. Everybody comes to you for everything. So that's awesome. And for small business owners listening, it's something that you need to, if you're not quite in that pickle yet, don't get so attached. Have other people get attached and work on it, not in it. I think Dwight would agree with that. Anyway, so just recently or the last few years, you started DWD Tax Strategy. Is that right?
Yeah, we're 3 years old at this point. DWD Tax Strategies. A lot of people think that's my initials because it's Dwight Dye, but my middle initial is actually A. So just to let everybody know, it stands for damn well done. DWD.
Okay. That's interesting. I thought it was your name too, but if you went with your name, everybody call you Dad. So I mean,
right,
you don't want that.
Right.
So tell everybody kind of what you focus on beyond the normal kind of tax strategies, the Augusta Rule, accountable plans, retirement planning, those sorts of things. What are some of these advanced strategies that you assist people with?
Well, those strategies you mentioned are all great foundational type strategies. And if you're a business owner, I recommend you still doing those, but those only get you to a certain point. And if you're really making some money, you're still going to have a tax liability left over after using those. And when you think about using those strategies, the amount of money that you're putting in is greater than the tax savings. So for example, if you were to hire your children, and let's say you pay them, you've got 2 children, you pay them $30,000, $15,000 a piece, and you're at 20% tax rate. Well, you've really only saved $6,000, but you've spent 30. So the strategies that I prefer and that I use are what we call leverage type strategies, where the amount of money that we're putting in is smaller than the deductions. Right. So the deduction is going to yield a larger tax saving than the money that you're putting into it.
Yeah, no, that's awesome. And just, for those that are on my level of education, to dumb it down for you, basically what Dwight's saying is when you're putting money in, you have to invest dollars to save on taxes, whether it be into retirement, paying your kids, those sorts of things. That's a great play. And there's, benefits to that. But what Dwight is saying, you leveraged means using other people's money, essentially, right? And whether it be seller financing, bank financing, that sort of thing, you're putting less capital in up front, but getting max deduction on the front end, right? And so you do that, and then you're anticipating cash flow covers that debt service. Is that?
Yeah, specifically with the equipment leasing strategy, it's designed that you receive a monthly rental income. That monthly rental income is enough to service the debt associated with the loan, plus leave a little bit of cash left over each month. So you are forming a profitable equipment rental business with this. We're not losing money. We're just using the tax code to the way it's designed. We're buying assets and then depreciating that against our other income, showing a paper loss. So it's a real powerful strategy. It's actually a 10x type return because you're putting 10% down on the equipment, but financing 90%, but you're getting 10x that amount in equipment, which then you can depreciate. And thankfully, with the new One Big Beautiful Bill, we've got 100% bonus depreciation. Right. So whether it's Section 179 or bonus, either way, you can write off 100% of the equipment.
Yeah, and that's a huge strategy. And, let's just say you were going to buy $600,000 worth of equipment and you're in the 30% effective tax rate. That's $180,000 that you're going to save on taxes. You have to put about 70 in with fees and your down payment, but then the cash flow from that, that rental of that equipment, leasing that equipment, is going to cover that debt service for 5 to 6 years. And so you're leveraging other people's money to save your own, where you can invest in additional strategies per se, like short-term rentals or real estate, right? There's a huge thing out there on real estate, Dwight, and I've had this conversation with folks several times. One is the real estate professional designation. Everybody thinks they can save money on real estate, but in fact, if you make an average kind of median amount of money, you can't.
Right.
For a while, right?
Mm-hmm.
But the benefits of putting equipment leasing or something advanced like that in front of maybe a real estate acquisition, because real estate's great. We love long-term appreciation and.
Right. Real estate, as far as I'm concerned, as far as building wealth, is a great way to do it. Even with bonus depreciation being back at 100%, though, the tax savings with real estate still pale in comparison to the equipment strategy. So even if you did a short-term rental loophole, which doesn't have really an income threshold there, as long as you're active in the short-term rental, you're having to put 25% down because it's an investment property. So already you're putting more cash into the deal than you would be with the equipment. And just for comparison, let's just say you buy a $500,000 short-term rental. Well, 100,000 of that's the land. So now we're down to 400,000. We have our cost segregation study that maybe yields 25% the first year that we can bonus. Mm-hmm. So we're down to deducting about 100,000, and at a 30% tax rate, that saves us 30 grand.
Right.
But we had to put 25% down of the 500 grand.
Yeah.
So we can buy the same amount of equipment for $50,000, depreciate the full $500,000, and our tax rate, at a 30%, a $500,000 purchase, we've saved $150,000 in taxes.
Right. Now you can go do your real estate deal if you want to, right?
Then you go do your real estate.
Yeah.
So now we've got the tax savings to go do the real estate with. So you're correct. You just need to do it in the right order. I'm not opposed to real estate. Just do it in the right order.
Yeah, I think they're powerful, compounded together. And I will say this, for all those that are speculating about buying a short-term rental, that short-term rental loophole, that's an effective strategy. Short-term rentals are a pain. I just be real. They're
and you have no guarantee if they're going to rent or not.
Right. Right. Yeah.
You may be stuck with a mortgage,
right.
every month.
Yeah. They truly are. If that's your business, that's your business. But to circumvent that, if you're a high income earner working, 40, 50, 60, 70 hours a week, spouse with kids, and managing a property, which is, that's difficult. So anyway,
right.
Share some success stories, of oh wow moments that maybe some of your clients have experienced through some of these strategies, and what has been the reaction to them? Is it well, let's put first, like, fear of entering into these types of engagements or strategies. Where's that comfort level at? How do you bridge that with folks?
Well, I think first of all, people are like, well, I know nothing about renting equipment, and I didn't either. 3 years ago. Not only am I helping people with this strategy, I'm also an equipment owner myself. So this is something that I personally use, so I can give people insight on how it is to be an equipment owner. But I can, if you'd asked me 3 years ago what a telehandler was, I'd have looked at you like, what in the world are you talking about? Or a telescopic boom. I didn't know any of that. I'm a tax guy, right?
Right.
So, the good thing is it's kind of a done for you program where all the components are in place for you to just step in, purchase the equipment. You do have some, managerial type oversight with approving your equipment to be available for rent each week, which gives you a regular and continuous participation in the activity. So that's probably the biggest one, is that people think that they have to know about, the equipment rental business, and you don't have to. So that's the first thing. And then obviously they want to make sure that each month they're going to get their rental income like they've been promised. They don't want to have to come out of pocket to pay that loan payment. And so far, this is a 10-year program. And over that course of the 10 years, the rental company has always made enough profit and enough revenue to send back to the rental platform to distribute out among all of its owners the exact amount of what they're expecting. So, over the 2+ years that I've been an owner, I've never had to remind them, hey, send me the rental income, or it wasn't what it was supposed to be. It's always to the penny, the exact amount that what I'm expecting. So it's worked well so far.
Yeah. So from a standpoint of, the tax geek side of things is, there's at risk, right? There's elements that you have to hit in order for it to be deductible. At risk is one of those things. So, meaning that if you take out the debt, you have to be personally at risk. So if, God forbid, something happens and it does blow up, you've got, $500,000 worth of equipment sitting in your driveway, right? If the program doesn't work, it hasn't in 10 years, but you have to be at risk. This is a business investment that you are making. It's not just, hey, here's some money, save me some money. That doesn't work, right? You have to be involved in it. You have to kind of manage it. Look at the reports, communicate with the company, have plan B and C should the equipment leasing relationship that you have in place not continue for some reason, right? That's what real business owners do. That's what you're doing right now in your business. So it's no different. But in order to be deductible, it has to be at risk, right, Dwight?
Correct. Yeah, because what we're trying to do is offset active income, and we have to be active in this new business. So you have to be considered at risk to make that work.
Right. So offsetting W-2 income. This can also offset W-2 income, correct?
Correct. Now, this year, one of the negatives to come out of the Big Beautiful Bill is the excess loss limitation was lowered down to $512,000 for married couples. So what that means is if I'm a W-2 employee and I'm making $600,000, whether it's just you plus your spouse's income or whatever the case may be, you can only deduct $512,000 against that $600,000 of business losses. So
if you're filing jointly, right?
If you're filing jointly, if you're single, it's about half of that. It's right. $256,000. So there are some limits in place where you can't just, if you make above that, completely zero out your W-2 income. Yeah. Now, for business owners, though, there is no threshold. So, if you're making $1 million in your business net profit, theoretically, you could buy $1 million of equipment and pay no taxes. That's how the program would work.
What if you have a million in net profit from your business and $600,000 in W-2 income?
Well, at that point, you would only be able to deduct. Well, I don't know. That's a good question.
Yeah, I think. I mean, from my vantage point, the way I see it is, you can buy, $1.6 million of equipment. I mean, you would only get the 512 on the against the non-active income, but you could offset 100% of the business and then a portion of that W-2 income. But
I would. Another thing to think about is the net operating losses. So, sometimes when we get to that client who's making, either right at the threshold or, a little bit over. Well, I say a little bit over. Let's say we've got a client who makes $1 million on a W-2.
Sure.
Well, a lot of people just say, okay, well, let's buy $500,000 of equipment and at least save them that much. And then maybe pair it with a charitable type deduction, up to 60% of that remaining AGI. But you can actually buy more equipment than you need this year, which would generate a net operating loss because you can't use all of it. That would carry forward to next year. And then you can deduct up to 80% of your AGI next year. You're not subject to that excess loss limitation in the following year.
Right.
So that's also a way to kind of, I mean, it's not circumventing. I mean, it's the way the law is written.
Yeah, I mean, it's totally up and legitimate. There are steps and things that you have to go through. And that's why we align with Dwight. He's become an expert in this particular strategy, as well as connected with the platform that runs the back end, which is a very powerful tool. And really one of the reasons why, folks are attracted to it. It's not a ton of hands-on work, it's management work. You're actively managing what's going on. But no, that's great. Dwight, any other strategies that you see out there when you talk to people that folks just aren't aware of and aren't doing that they should? And this could be advanced or non-advanced strategies that you're running across.
Well, it's amazing the connections I've been able to make over the past 6 to 9 months with all these different types of strategies. And, last year, my goal was to just stick with equipment leasing. And, I had people that I met with that didn't understand it or they didn't want to do it. I didn't really have anything else for them because that's all I wanted to do to help people. This year for 2026, I've established a few other strategies to add to the arsenal. And, but they're all leveraged because here again, we're using other people's money to maximize our deductions. There's a charitable leverage deduction where, say you donate 25,000, normally you can only deduct that 25,000. That's your charitable donation, assuming you itemize. But with this charitable leverage type donation, you're able to 6x that 25,000. So instead of getting a donation for 25,000, you get credit for $150,000. So that could be real powerful for a W-2 employee who is making above that limit that we were discussing. Maybe they make $750 on a W-2. Well, they buy $500,000 of equipment. They still have $250,000 of, taxable income. So now we pair that with a charitable leverage play up to 60% of that remaining AGI, and their tax bill is really minimal at that point. So big fan of the leverage type stuff. There are some other strategies. It kind of depends on the client now. We can kind of, depending on what their needs are and their situation, there's some other plays kind of like the equipment leasing strategy. It's not with equipment, it's with other type of assets. There's just some little nuances. So one client may prefer that over the equipment, or somebody may prefer the equipment. So I like now being able to have options for people when I meet with them.
Yeah, no, that's fantastic. There's some unique things out there and things that I never thought I would see or comprehend. I'm like, that makes sense when you read it. It's not overly complex, a lot of them. It's just like, how did you connect those dots? But once you see it, it's like, okay, makes sense. So that's why we're aligned with Dwight, and we work with some of the same, partners out there as well in terms of tax strategies. But it's important that you at least ask the questions and get on a call with somebody and just see, hey, might I qualify? If you have a tax bill and you're not talking to anybody about it, that's really on you, because there are options. Now, there might not be one that's a fit for you right now. Who knows? There's certain different elements in play or things you have to kind of check the box on, but it's worth looking into them if you are paying taxes each and every year. So one thing from the One Big Beautiful Bill, and we'll wrap it up, is, research and development credits and the ability to, go back, and if you were amortizing them before, back to 2022, 2023, you had 2022, you got to do real quick here in the next few weeks, but you can go back and recapture those credits and save significantly. We've got a client that we did as soon as that bill came out. We're like, and so for 22, 23, already did 24, combined, they're looking at about $200,000 in tax credit split between two partners. I mean, that's good money to bring home to mama,
Sure. Yeah.
at the end of the day. So, and it didn't take a heavy lift. It was an introduction. It was an analysis and put in the work. So something to be considering out there, especially 2022 might be too late, but 2023 still open for all you guys. And if you have any questions, feel free to reach out to me. If you want to get connected with Dwight, I recommend you do so. Dwight, where can people find you?
I'm on every social media platform under my name, Dwight Dye. And then my website is dwightdye.com. Just try to keep it simple. I am in the process of refreshing that website to include these other strategies that we kind of alluded to today, because right now it's just focused on equipment leasing, but there's more to come. And then too, we want to be smart with those tax savings. We don't want to just waste those tax savings. We want to use that to build wealth in the coming years. So I'm working on some strategies with that as well, where people have an option to divert these tax savings and never pay taxes on any of that money again. So, yeah. So
no, that's great, guys. Glad you could join us. I know there's a ton of information shared here. Watch it, share it, let people know. And if you have any questions or feel like you might have some tax credits or opportunities to save out there, reach out to either one of us, reach out to me. We'll do a group call, whatever it needs. We work together often. So we just want to save the taxpayer money the right and legal way. So thanks for joining. We see you again next time.